Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I've been getting into a little bit about the markets and how this works and about how you can protect yourself with regard to your portfolio design, that this is a great time, in fact, to be looking at that. All right, quick reminder, I'm going to throw up this chart, lowering your sights. All right, again, this is the one that shows over the last 30 years what the return on the U.S. Stock market. So let's throw up that one, Marilyn, on lowering your sights. This is on U.S. equities and then on European equities, U.S. bonds and European bonds over the last 30 years, what the return was. This is above the average, okay? So the last 100-year average return is about 6.5%. We've been running at 7.9. On bonds, again, the average over the last the average then that they're saying, let's stick with stocks for a moment. So over the next 20, if it were the average of 6 would indicate that we would actually see somewhere around 4 to maintain that, and that's what the expectations are. European equities, the same thing, about 7.9 over the last 30 years, well above the 4.9 average. What we're looking at there is a return probably more in the 4.5 range. U.S. bonds at 5%, again, well above the average. And what we're looking at is maybe around a 2% or less on the average bond return. In European bonds, you can see the same thing. So again, what this means basically with regard to portfolio design. If you want to know a little more about your own analytics on this, here's one of the things we'll do. For the first 10 callers to my office this morning at 615-376-5325, I do a comprehensive plan for you. A big part of that, of course, is portfolio analysis. We take a look at where you're at today. We do projections to show where you're going to be in 5, 10, 15, 20 years based on the average expected returns on your current investment plan. All right, so whether that's, we're looking at bank money, CDs, we're looking at investment portfolios, stocks, bonds, mutual funds. If you have REITs, ETFs, whatever it might be, we break that down and we delve into it to show you what risk is inherent, especially in those mutual funds. This is one of those areas that if you've got individual stocks and bonds, we can do the same thing, of course. However, those are a little easier to see yourself, but you may not be as aware of what the bottom line on some of these companies and what it may mean with regard to risk. And even if you look at the credit quality of the bonds and that you have, whether in your mutual funds or whether they're independent ones. If you'd like to know more about that and see where you're at, and in fact, in a bear market, what may happen with your portfolio, just how much you would expect to lose or drop in that period, and how long it may take you to recover from that period, and then how income plays into that. All of that is a part of this analysis that I'll offer up. So again, for the first 10 callers to my office, 615-376-5325, as a part of that comprehensive plan, we're going to do an investment analysis for you, help you see where you're at today and how you can improve upon that. And among other things that we do. Again, at no charge, you get to, here's what will happen. You call the office. Debbie will take your information. She'll send you out a little checklist of things to bring to the appointment. She can either send you a book, or we can, when you come in, I'll provide you a copy of my book, 7 Steps to Financial Freedom in Retirement. And that'll go over. There's a chapter in there on how the smart money invests. It gets into portfolio design. And of course, we're going to show you how that works and the academic research that's out there. There's a science to investing and a way to invest in such a way to protect yourself against downturns. Okay. So again, first 10 callers, 615-376-5325. Debbie's standing by. She'll get your information and schedule a time for you to come in and see me. One of the things, going back to this McKinsey report, I'm going to share some things that accompanied that. The golden era, as they put it, is now ended. What they talk about is over the last 3 years, corporate profit growth was ever stronger, reflecting revenue gains in new markets, declining corporate taxes, advances in automation and global supply chains that helped rein in their costs. So they were to lower their costs, of course, increase profits. Publicly listed North American companies alone increased their post-tax margins by 65% in this last 3 decades, over the last 30 years. Well, now it says, as McKinsey is saying, this golden era has now ended. All right. What we're seeing, in fact, is that the forces that have driven exceptional returns are weakening, and in some cases even reversing. The big decline in interest rates, okay, and inflation is reaching its limits. Global GDP growth will be lower as populations in the developed world and China age. And this is, we've talked about, the aging of the population, not just here, but around the world, is going to have a negative impact with regard to productivity. All right, so the outlook for corporate profits is cloudier, and this is another. easy for me to say, right? Digitization, I'll get it out, all right, and disruptive technologies could boost margins for some companies. So in other words, the more we automate, the more we reduce our labor costs, as an example, or overall costs in general, but we're reaching limits on that as well. And this is the other part. This could also create other problems for other companies, okay? So it could boost margins for others, reduce it, put other, and this is where jobs come in again. This could put a lot more people out of work, of course. And there's a switch over then as to what kind of jobs they may be able to get. Big North American and Western European firms that took the largest share of the global profit pool in the past 30 years face new competitive pressures from emerging market companies, and that, again, technology giants, digital platform-enabled smaller rivals. These forces, of course, may curtail margins and reduce profits in the future. All of this, they continue to go on, are looking at these gaps that we're seeing in terms of potential return going forward compared to what we've had in the past. So there are a lot of different, not just local or U.S. forces, but global forces that can affect it. Let's take a look at one other thing here. The economic and business drivers of equity and fixed income returns are stunning. So this is this last slide. Inflation is one of those we're going to take a look at. So over the last 30 years, inflation fell from above 10% a year in many countries in the early 1980s to below 2% after 2008. So there's one change. Over the next 20, however, more likely to rise, that is inflation, of course, from the lowness that it is now, than fall as the economy recovers. In particular, inflation is so low right now, it only basically has one way to go. All right, another thing, interest rates at historic lows. So the nominal rates on 10-year government bonds fell from, again, in that same period, above 10% in the 1980s to about 2% or lower today, about 1.8, I think, the last time I looked for 10-year treasuries. And this is, when you look at other countries, again, low and sometimes even negative interest rates. Over the next 20 years, then, the expectation is little room to fall further, right? Interest rates are about as low as they're going to get. We know the Federal Reserve wants to raise them. They know they need to raise them. So it's going to just be a matter of time. So little room to fall further, but speed of future increases is what's uncertain, because reflected again and when the Federal Reserve tried to raise rates just 0.25% last year, the effect that had. GDP growth, this is another one. Over the last 30 years, robust growth due to strong productivity gains and increased employment. What are we seeing today? We're seeing employment is much higher. I mean, the 5% approximately that's being touted as our employment rate doesn't, of course, take into those that underemployed segment, those people that are not looking anymore. When we add that in, the numbers in the double digits, probably 12 to 15%, depending on what research you're looking at. So over the next 20 years, the expectation would be without big productivity gains, growth could be weaker as employment growth slows even more. All right, and in corporate profits under pressure, new markets, low cost, over the last 30 years that is, new markets, low cost labor, global supply chains, and falling corporate taxes boosted margins. Now we know in the U.S. at least, we have some of the highest corporate taxes in the world, and that's one of the reasons that we've got a problem, and this goes into feeds into all of these things if you think about it. Next 20 years, emerging market companies and new tech competition could cut margins even further. So what we're seeing again is a very slow to no growth indicators over the next 10 to 20 years. How can we fix that? Well, or how, and more importantly, there's some things we can, politically, we can go ahead and get rid of that slide now. All right, there's some things you can talk about of how that gets done. Big part of it is, again, jobs. Goes back to jobs. We got to get more jobs in. One way to do that, cut corporate taxes. That'd be a big step in that direction. Both parties acknowledge it. I hope they get it together and figure out a way to get that passed next year so that we can get on with things. All right, more people working, more people paying taxes. Now our debt starts coming down. A lot of things get better. You can raise interest rates, your inflation, all the rest of those things are going to be able to take care of themselves. How do you protect yourself? Again, we don't know which way it's going to go, do we? Or how soon it might happen. One of the things I would say, in particular over the next, let's say, 3 to 6 months, is to be even more conservative than ever in terms of how you're investing, okay, and making sure how that's done. We're going to talk about in a moment. We're going to take a break. When I come back, I'm going to talk a little more about that importance of portfolio design. And again, for the first 10 callers, I'm going to give you another opportunity to get in and have your own personalized plan developed for you to protect you and your family. All right? Join me here. We'll be right back on the Retirement Report.